Something unprecedented just happened in the markets. Silver crashed to $71 and then exploded 17% in just a few hours. $10 trillion disappeared from the precious metals market in 72 hours. Gold, the ultimate safe haven, sold off like a penny stock. Bitcoin warned about this days before it happened by crossing the exact threshold analysts had identified. Central banks did not sell. Tether did not sell. Governments did not fix their debt problems. So why is gold bleeding like this? Someone needed liquidity fast. And when institutions sell what they can instead of what they want, something inside the system is about to break. This is not a dip. This is a signal. Before we dissect what just unfolded, hit the subscribe button below. If you've been watching the financial world unravel and wondering what it actually means, you're in the right place. We don't do hype. We don't do fear. Just the data, just the analysis, and just what you need to understand what's coming next. And tell me in the comments where you're watching from today. New York, London, Singapore, or somewhere in between. Because what we're about to break down changes everything. The markets opened Monday morning with violence rarely seen in precious metals. Silver dropped straight to $71 per ounce. Not gradually. Not with warning. It collapsed. Then something shifted. Within hours, silver didn't just stabilize. It surged back to $83, a 17% recovery in a single session. Traders stared at their screens trying to process what they were witnessing. This wasn't normal market behavior. This was chaos followed by relief followed by confusion. The question was simple but urgent. Was this the bottom, or just a pause before the next wave of selling? To understand the scale of what happened, you have to zoom out. In just 72 hours, $10 trillion evaporated from precious metals markets. Gold fell 20% from its peak, erasing $7.4 trillion in market value. To put that into perspective, that's 5 times the entire market capitalization of Bitcoin. Silver collapsed nearly 40%, wiping out $2.7 trillion, roughly equal to the entire cryptocurrency market. These aren't small numbers. This is generational wealth disappearing in real time. Gold and silver are supposed to behave differently from speculative assets. They are supposed to protect wealth during uncertainty. Yet they moved like tech stocks, like meme coins, like assets people dump when panic hits. Analysts rushed for explanations. Some blamed political speculation. Others blamed technical stop-loss cascades. But the data told a different story, and most people weren't paying attention to it. The Shanghai market showed something critical. While Western markets were bleeding, Eastern markets were holding firm. During the peak of the panic, the premium between Shanghai physical silver prices and Western futures reached 43%. By Monday pre-market, that premium compressed to around 22%. Still elevated. Still abnormal. Two markets were pricing the same metal completely differently. In the West, silver was being sold aggressively. In the East, it was being accumulated. This kind of disconnect doesn't happen by accident. It happens when smart money sees opportunity while scared money runs for the exits. Gold followed a similar pattern. It hit a low near $3,299 and then recovered roughly $250 of its $450 loss, a 7% bounce. Respectable, but not nearly as violent as silver. This divergence raised another question. Why did silver rebound harder? Silver is more volatile, yes, but a 17% intraday recovery suggests something else. Forced covering. Short squeezes. Positions being unwound at the wrong time. As the New York session approached, traders faced a decision. Enter now and risk catching a falling knife, or wait and risk missing the bottom. Relief bounces happen all the time in bear markets. They look real. They feel convincing. Then they collapse. But sometimes they mark the turning point. The moment when maximum fear creates maximum opportunity. The challenge is knowing which kind of bounce this is. What made this moment so critical wasn't just the price action. It was the context. Nothing fundamental had changed. Central banks hadn't sold their gold reserves. Governments hadn't solved their debt crises. In fact, the U.S. government had shut down over spending disagreements. That is normally bullish for gold. Yet gold sold off like the crisis had ended. That contradiction was the real story. 3 days before silver collapsed, a warning signal appeared in an unexpected place. Not in gold. Not in bonds. In Bitcoin. The thesis was simple. Bitcoin trades 24 hours a day. It reacts first to shifts in risk sentiment. Analysts said if Bitcoin closed below $82,000, contagion would follow. It didn't just close below 82,000. It dropped to 76,000. By Sunday night, it touched 74,500, the exact level identified as confirming weakness. Then Monday morning, silver collapsed to $71. Gold fell below 3,300. The correlation was not coincidence. It was mechanical. When Bitcoin breaks down, leveraged portfolios feel pressure. Funds don't sell their worst assets. They sell their most liquid ones. Gold and silver futures are liquid. They become the release valve. Once margin calls were satisfied, something changed. Silver surged 15%. Gold rebounded 7%. Bitcoin stabilized. This synchronized recovery showed the selling wasn't fundamental. It was forced liquidation. A classic capitulation flush. But the real question is whether this was the final flush or just the first one. Markets can flush multiple times. Each bounce feels like the bottom. Until the next drop arrives. The signal now rests with Bitcoin. If Bitcoin reclaims 82,000 and holds, the danger passes. If it fails, the nightmare continues. Gold must hold above 3,300. Silver must hold above 75. These are not emotional levels. They are mathematical levels that separate reversal from continuation. Something deeper still doesn't add up. Gold is supposed to rise when systems are stressed. Yet it fell 20% in 72 hours. Central banks didn't sell. Tether didn't sell. Governments didn't fix debt. So who sold? The answer is paper gold. Futures contracts. Digital positions. Not physical bars. Physical markets stayed strong while paper markets collapsed. That's why Shanghai traded at a 22% premium. This tells us the selling wasn't belief-driven. It was necessity-driven. Someone needed cash now. And when forced selling enters the system, quality assets fall first. And when that happens, it is never meaningless. It is a warning. The bounce raised a dangerous illusion. A 17% recovery in silver and a 7% rebound in gold felt powerful, but power alone does not mean safety. History shows that the most convincing rallies often appear inside the most destructive declines. They give traders hope, they pull buyers back in, and then they disappear. The real question was never what just happened. The real question was what comes next. And there are only two possibilities. Either this was true capitulation, where forced sellers are finished and a bottom is forming, or this was a technical relief bounce inside a much larger unwinding that has not yet completed. If this was genuine capitulation, certain things must follow. Volume on the rebound must exceed volume on the collapse. That would signal real buying, not just short covering. The Shanghai premium must compress from 22% toward normal levels, showing that physical and paper markets are reconnecting. Bitcoin must reclaim and hold above $82,000, the same level that warned of collapse when it broke. Gold must stay above 3,300 through full New York trading sessions. Silver must hold above $75. These are not emotional targets. These are structural levels that separate recovery from continuation. But if this is only a relief rally, the signals will look very different. Volume will fade as price rises. Shanghai premiums will remain elevated or expand again. Bitcoin will fail near 80 to 82,000 and roll back down towards 74,000 or lower. Gold will struggle near 3,400 and break again toward 3,000. Silver will fail near 85 and retest 71. This is how bear market bounces die. Quietly at first, then violently. What makes this moment so dangerous is that nothing fundamental has improved. Debt levels are still rising. Governments are still paralyzed. Central banks are trapped between inflation and recession. The U.S. government shutdown did not end. Fiscal discipline did not suddenly appear. Yet gold sold off as if risk had vanished. That disconnect reveals that this move was not philosophical. It was mechanical. It was about margin calls and liquidity, not confidence in the future. To understand who sold, you have to understand how gold trades today. There is physical gold and there is paper gold. Physical gold is bars in vaults, coins in safes, metal that requires trucks and guards to move. Paper gold is futures contracts, ETFs, derivatives, and digital balances. It trades instantly. And when institutions need cash fast, they do not ship metal. They hit sell on contracts. This is why Western futures collapsed while Eastern physical markets held firm. At the height of panic, Shanghai gold traded at a 22% premium. That is not normal arbitrage. That is structural dislocation. A 22% premium means physical buyers were willing to pay far more than paper markets were offering. It means the two markets were no longer unified. It means one side was panicking while the other side was accumulating. This is exactly what happens during liquidity events. The paper price crashes first. Physical reality lags behind. History shows what follows these dislocations. Either paper prices rise to meet physical demand, or physical markets eventually weaken to meet paper. But when fear dominates, physical holders do not rush to sell at massive discounts. They wait. They understand that a bar in a vault is not the same as a digital promise of delivery. Especially when counterparty risk is rising. This brings us back to Bitcoin. Bitcoin was not the cause of this collapse. It was the messenger. 3 days before silver fell to $71, Bitcoin broke below 82,000. Then it dropped to 76,000. Then 74,500. That breakdown was the warning shot. Crypto trades without interruption. It reflects sentiment faster than any other market. When it cracks, leverage elsewhere feels the strain. Funds holding crypto, metals, equities, and commodities all face the same margin rules. Losses in one area must be covered with gains from another. The only question left is simple. Will this moment be remembered as the day fear created opportunity, or the day opportunity became a trap? That answer is coming very soon.